Right, good morning, grade 12s. Today we'll be doing the second last lesson of chapter 6. So we're going to look at the different types of shares. Some of this work is quite challenging and it gets quite confusing, so you really need to study this well. All right, remember we are going to distinguish between ordinary shares and preference shares. So if we look at the ordinary shares first, ordinary shares will only receive dividends when a profit is made. Okay, remember in previous lessons we said with the ordinary shareholders, they will only receive dividends if a company is making a profit. So if the company is making a loss, your ordinary shareholders will definitely not receive a dividend. But also remember they will only receive dividends if a profit is made and the board of directors decide that dividends will be paid out. Okay, normally the way it works is that the higher the net profit, the higher the dividend. So in other words, the more profit the company is making, the higher the dividend that they will be willing to pay out. All right, we have mentioned before also, your ordinary shareholders are the last people to be paid should the company be liquidated. So if the company makes a constant loss over a number of years, and eventually the company is no longer able to settle debts, and they decide to close down and liquidate the company. Remember, liquidation means they're literally selling the assets of the business and they're closing down the business. Now, the way it works is that creditors will be paid first. Okay, so any money that the company owes to others will be paid first. If there is money left over, then the preference shareholders might receive some of the money that they have invested back. And only after that, if there's money left, your ordinary shareholders might get some of their money back. Okay, remember the money that we are referring to here is the money that they have originally invested in the shares. So the money that they spent when they bought the shares. They can only get that back when the company is liquidated. And as I said, your ordinary shareholders is the last ones to be paid, should there be money left over. So chances are that they are definitely not going to get all of their money back. They might get some of their money back, but the chance is also there that they will get none of their money back. All right, obviously dividends will vary from year to year because it depends on the profits that is made by the company. All right, so depending on how big the profit is made for that financial year, the board of directors will decide how much the dividends will be that they're going to pay out. So the dividend is not going to stay the same every year. It is not predictable and dependable. So if the company makes a profit and if the board of directors decides to pay out a dividend, then only will they receive a dividend, and the value of that dividend will vary from year to year. Right, your ordinary shareholders automatically have a right to vote at the AGM. Remember, public companies by law are required to have an AGM once a year where the ordinary shareholders have a right to attend this AGM and they have a right to vote. Remember, we said one share equals one vote. So the more shares you have, the more votes you have at the AGM, where they will vote on different things. Now, if they need to appoint a board of directors, if they're going to decide if they're going to expand their business, if they want to add another product to the existing product line, any major decisions that has to be made will be made at the AGM and the shareholders will have a right to vote there. Right, so what are the rights of our ordinary shareholders? Okay, your ordinary shareholders have the right, as I said, to vote at the AGM. Right, automatically, if you're an ordinary shareholder, one share, one vote. Okay, they need to attend the AGM, or they have the right to attend the AGM to learn about the company's performance. At this AGM, one of the things that are compulsory for them to discuss at the AGM is the financial statements of this company. All right, so all the shareholders must be given a copy of the financial statements, the income statement, the balance sheet, and then the financial performance and the financial health of the business will be discussed at this AGM. So the ordinary shareholders, as part owners of this company, obviously have a right to know what is happening with the finances of this business. Remember, their dividends depend on the successful financial management of this business. So they have 100% right to know what is happening with the finances. Right, they also have the right to receive interim and annual reports. As I said, interim is before the end of the financial year, and your annual reports, as I mentioned earlier, will include the income statement as well as the balance sheet, so that they can analyze the financial health of the business. Right, they do have a claim on the company's assets in the event of bankruptcy, but as I said, they are last in line to receive anything. Now, as I said, if the business goes bankrupt, if the business closed down and they are liquidated and the assets are sold, the first people that will be paid will be the creditors. After that, the preferential shareholders, and after that, if and only if there's money left over, will the ordinary shareholders receive some of their invested money back. They will definitely not receive it all. If the company has enough money to settle all of their creditors and pay all the preferential shareholders and all their ordinary shareholders, they would not have been liquidated in the first place. Okay? They get liquidated because they don't have money. Their cash flow is a problem. Right? So your ordinary shareholders might definitely not get all of their money back. Right, if we go to the preference shares. Right, now some of these types of shares you're going to see, we're going to do a whole section on different kinds of preference shares. Some of the preference shareholders will receive a dividend regardless of whether a profit is made or not. So some preference shareholders might receive their dividends even if the company is making a loss. Okay, but we'll look at the types of preference shares later. Right, on the preference shares, there is a fixed rate of return. So the difference between ordinary shareholders and your preference shareholders, remember with an ordinary shareholder, you will get your dividends only if a profit is made, and the bigger the profit, the bigger the dividends, depending on what the board of directors decide. With a preference shareholder, there is a fixed rate of return. So the dividend that you receive at the end of the financial year is fixed. Okay, so it doesn't depend, in other words, on the profit. It doesn't depend on whether the business is making a profit or not, and whether the profit is big, whether the profit is small, whether they make a loss. There's a fixed rate of return, a fixed dividend. Right, as I explained already, if you're a preferential shareholder, you have a preferred claim on the company's assets in the event of liquidation. Just remember, the preferential shareholders are definitely not first in line. Obviously, should the company be liquidated, as I said, your creditors will be paid first. After that, if there's money left over, the preference shareholders might get some of their original investment back. Okay, it will depend, obviously, on how much money is left after the company's debts were settled. Right, these shares also enjoy preferential rights to dividends over ordinary shareholders. Okay, as I said, some preference shareholders even receive a dividend if the company is not even making a profit. All right, so they do receive their dividends before the ordinary shareholders. And after the preference shareholders have gotten their dividends, then obviously if there's money left over, your ordinary shareholders might receive their dividends. Okay, so some years your preferential shareholders will receive dividends, whereas your original shareholders might not. Right, your dividends are payable according to the type of preference share. As I said, there's different kinds of preference shares, and that is a section that we will look at the end of this lesson. All right, but the kind of dividend that you receive as a preference shareholder will depend on the type of preference share that you have. They're not all treated the same. Right, your preference shareholders, another major difference with the ordinary shareholders is that your ordinary shareholders will automatically have voting rights at the AGM, whereas your preferential shareholders will only have a voting right under particular circumstances. Okay, so they don't have automatic voting rights. They will have voting rights in a certain situation only. They don't automatically have a voting right. Right, your non-cumulative preference shareholders will not receive any outstanding dividends from previous years. You will see we distinguish between cumulative preference shareholders and non-cumulative preference shareholders. All right, your cumulative preference shareholders, if in the previous year the company did not have money to pay out dividends, then if you have accumulative preference shares, in the following year they will pay you out the dividends from previous years that they couldn't pay out in previous years for whatever reason. But if your preference shares is non-cumulative, in those years when you did not receive a dividend, that doesn't accumulate into the next year. So when one financial year is over, it is over, and if the company does not pay out dividends, you cannot claim those dividends in any subsequent years when they actually do make a lot of profit. All right, cumulative preference shareholders, I have already explained. They will receive outstanding dividends from previous years, so their shares will accumulate. The value of their dividends will accumulate. So if there's been 5 years that they have not received dividends, in year 6, when the company makes a large profit, your cumulative preference shareholders will receive their dividends for all 5 of the years they have not received, plus then the current year, which doesn't happen if your shares are non-cumulative. Right. Then we also distinguish between redeemable and non-redeemable preference shares. Right, your redeemable preference shares can be bought back at the option of the issuing company on a predetermined future date. Okay, so when you buy the preference shares, if they are redeemable at the original transaction, on the date of the original transaction, the issuing company, the company whose shares you are buying, they will take the option of buying back their shares at a specific future date. All right, so if you have redeemable preference shares, the option is there. The company has the option to buy back their shares at a specific date sometimes in the future. It will not depend on the fact on whether you want to sell or not. When that date arrives, the company will decide, yes, they want to buy their shares back, or no, they don't want to buy their shares back. When the preference shares are non-redeemable, the only time that non-redeemable preference shareholders will be bought back by the company is when the company closes for reasons other than bankruptcy. Okay, so remember, when the company is not liquidated. Right, so the company closes down for any other reason than liquidation, then the company will buy back non-redeemable preference shares. Okay, but only if the company closes down, physically closes down, and only if they close down for any reason other than liquidation. Right, then we also distinguish between convertible and non-convertible preference shares. Your convertible preference shares are converted to ordinary shares after a fixed period or on the date that is specified when those shares were bought. So on the day that you buy your preference shares, if they are convertible, it would be stated that those convertible preference shares that you are buying at some date or on some specific date in the future or after a certain amount of time has passed, your preference shareholders will automatically be converted into ordinary shares. If you have non-convertible preference shares, obviously they will not be converted into ordinary shares at any given point in time. They will remain preference shares forever. All right. Right, so what are the rights of our preference shareholders? Okay, your preference shareholders have the right to receive dividends regardless of how much profits are made. Okay, this is different to your ordinary shareholders. Remember, in the ordinary shareholders, they will only receive a dividend if a profit is made, and the dividend will depend on how much profit is being made. With the preference shareholders, remember, their dividends is fixed, and they can receive a dividend regardless of how much profit is actually made. In certain cases, remember, they can even get a dividend if the company has made losses. Right, so the next right of a preference shareholder is that they have a right to receive a fixed rate of return. In other words, as I said, their dividend that they receive does not depend on the amount of profit the company is making. At the time of buying that preference shares, there will be an agreement with regard to the dividend that you will be receiving, and the dividend will be the same regardless of how much profit is being made. So this is kind of a guaranteed income. Right, they are paid first or enjoy preferential rights to dividends. Okay, so obviously if the company made only a small amount of profit, they will always pay the preferential shareholders their dividends first. And then if there is not enough profit left to distribute to the ordinary shareholders, during those years, the ordinary shareholders simply will not receive a dividend. All right, so even in terms of dividends, they have a preferential right to receive their dividends. Okay, I have already explained also that they do have a preferred claim on company assets in the event of liquidation. Okay, I said that in the case of liquidation, when the company closes down because they went bankrupt and all of their assets are sold, your creditors will be paid first, and then if there is any money left over, your preferential shareholders might receive some of their invested capital back, the money that they've paid for the shares when they bought them. Yeah, that's what I'm talking about here. All right. So in the event of liquidation, your preferential shareholders will receive or might receive a small payout, and they might receive some of their invested share capital back, only if there's money left, but before the ordinary shareholders will receive anything. Right, preferential shareholders will also receive interim and annual reports, okay, those financial statements of the companies. All shareholders have a right to see that. Okay, it's even printed, even people that are not members or shareholders of this company, because it is a public company and because they are encouraging members of the public to buy shares from them, everybody has a right to see their financial statements. Okay, so even your preference shareholders will receive the financial reports of the company. Right, I already said they don't have automatic voting rights at the AGM. They will only have voting rights in certain circumstances, when their vote is needed. Right, your cumulative shareholders, as I said, they must receive outstanding accrued dividends from previous years. So if in previous years dividends was not paid out, if you have cumulative preference shares, you have a right to receive any outstanding dividends from previous years that you did not receive in those previous years. Participating preference shareholders also have the right to share in surplus profit. Okay, so even after all the dividends have been paid out and there's still surplus profits left, your participating preference shareholders also have a right to get their share of those surplus profits. Right, if we now look at founders' shares. Right, these shares are issued to the founders and promoters of the company. In other words, those people that started this company, they will be issued with founders' shares. Right, and they receive dividends only after all the other shareholders were paid. So if both your preference shares and your ordinary shareholders have received their dividends, and if there is money left over, your founders' shareholders, they will receive their dividends. Okay, remember, these are the people that started this business. They are the original owners, the people that had the idea to start this business. All right, so they have a responsibility towards other shareholders. If they had a crap idea, it's their crap idea. All right, so they are only in line after everybody else to receive dividends should there be money left. Right, if we look at the bonus shares are when shareholders receive payment in the form of shares. So in other words, instead of giving them a dividend, you're going to give them extra shares. Right, so issued as compensation for unpaid dividends. As I said, when you are unable to pay out dividends to your shareholders, instead of giving them the dividends, you issue them with additional shares. But when people they receive bonus shares, obviously there's these shares that they are not paying for. All right, so your shareholders, when you give them the bonus shares, you are not going to receive any money for that. It is something that you give your shareholders without them paying for it. All right, for the shareholders, this will mean that when they receive additional shares, that they own more shares now, and in the future, they will be able to collect more dividends. Because remember, you will receive dividends based on the amount of shares that you have. So when you receive bonus shares, obviously this increases the amount of shares that you own. And in the future, should dividends be declared, you will be entitled to receive more dividends because you have more shares. Right, and as I said, shareholders receive these shares without paying for them. We are giving them these bonus shares instead of paying them a dividend. So they are not going to buy. Bonus shares are not being bought. It is something that we give to them without receiving any money in return. Right, now what is very, very important, that you must be able to identify types of shares from given scenarios. Okay, you will be given a scenario, and then you must be able to identify the type of shares that they are referring to in the scenario. Right, so the last thing that we are going to look at is the different types of preference shares. All right, the first one is participating preference shares. All right, so the shareholders of participating preference shares are guaranteed a minimum fixed dividend. All right, so if you own participating preference shares, you are guaranteed a certain amount in terms of the dividends that you are going to be received. A minimum amount is guaranteed, and then obviously should there be money available after paying out other dividends, you might be getting more. Right, they are entitled to share in any surplus company profit. So as I said, when the company is profitable, the participating preference shareholders will receive their minimum specified fixed dividend. But then should there be profits left over after paying out all the other dividends, then your participating preference shareholders are entitled to also share in any surplus company profits. So basically that means they will receive their minimum fixed dividend, and in addition to that, they might receive more money if there are surplus profits available. Right, so in other words, they will receive a higher dividend when the company performs well. Okay, because then, as I said, they will receive their minimum fixed dividend as well as their share of any profits left over. Right, so when the company performs well, they will also receive more money because they will not only receive their minimum fixed dividend, they will receive additional dividends as well if the company performs well, if the company made a decent profit. Right, and then again, because these are preferential shareholders, with any preference shares, any preferential shareholders have a right over and above the ordinary shareholders when the company closes down. All right, so remember we've said this many times in this lesson now. Should the company close down because of bankruptcy and they are liquidated, your preference shareholders will receive, or they have a better chance of receiving, a part of their investment back. All right, remember they will be paid out before your ordinary shareholders should the company be liquidated. Right, then we also have non-participating preference shares. It is still preferential shares, preferential shareholders. Right, with your shareholders, if you have non-participating preference shares, you will receive an amount equal to the initial investment, so whatever you paid for those shares initially, plus any accrued and unpaid dividends upon liquidation. All right, so should the company go into liquidation, if you have non-participating preference shares, you are going to receive your initial investment back plus any dividends that is owed to you. In other words, that it hasn't been paid out. Maybe in some years before, the company has been making a loss. You would not have received dividends in a couple of years before liquidation. So upon liquidation, they will pay out all of your unpaid dividends of previous years. Right, but because it is non-participating preference shares, they will not have a right to participate in profits after other shareholders have been paid a dividend. All right, so they will receive their specified dividend. Okay, same as with the participating preference shareholders, they will receive their specified minimum dividend, but they do not have a right to receive any surplus profits. They don't share in the surplus profits after all the other shareholders have received theirs. They only receive their minimum fixed dividend. Right, so now if we look at more types of preference shares, we also distinguish between cumulative preference shares and non-cumulative preference shares. Okay, Right, we have discussed this before when we did the preference shares, so just a repetition here quickly. Your cumulative preference shareholders are compensated for dividends that was not paid out in previous years when the profits were too low to declare a dividend. So if you have cumulative preference shares and year 1, year 2, year 3, year 4, the company does not make enough profits and a dividend is not declared, you would not have received dividends for 4 years. Then in year 5, the company makes a huge profit. As a cumulative preference shareholders, your dividends accumulates over the years. So all of those dividends they did not pay you in year 1 and 2 and 3 and 4, they will pay out in year 5 when, for example, they now make a profit. So you will be receiving your dividends of previous years when the company was unable to pay it. They still owe it to you now, and as a cumulative shareholder, as I said, your dividends accumulate and they will pay out those dividends when they can. All right, with your non-cumulative preference shares, this is shareholders that are not compensated. Okay, so their dividends does not accumulate. So in year 1 and 2 and 3 and 4, when the company was not profitable enough to declare a dividend, the dividends that these shareholders, the non-cumulative shareholders, were supposed to receive in those years, it falls away. Now, if there's no profit to pay out dividends, they simply will not receive a dividend. Their dividends owing to them does not accumulate. They will never receive those dividends of previous years when the company was unable to pay out a dividend. So once the company is profitable again, your non-cumulative preference shares will only receive the dividend for that current year. All dividends that were supposed to be received in previous years, it falls away. Yeah, they don't get it. Right, then we look at your redeemable and non-redeemable preference shares. Right, your redeemable preference shares, okay, we also discussed this earlier in this lesson, but redeemable means that the shares can be bought back at the option of the issuing company, either at a fixed price on a specific date or over a period of time. So when you buy redeemable preference shares, you will be told that the company has the right to buy back your shares at some specific date in the future or over a period of time. All right. So for now, you are a shareholder, but should the company decide on a specific date that they would like their shares back, they will buy back the shares from you and you will receive a fixed price. All right. So they will agree on a specified date and the fixed price that these shares will be paid back for when you make the original transaction. Okay, so when you buy the shares originally, it will be stated that this is the specified date. On this date, the company will decide whether they want to buy back your shares or not, and this is the price at which that transaction will happen. Remember, it is the option of the company, not the shareholder. You as the shareholder, you don't have a choice. If the company wants to buy back your shares, you have to sell it back to the company. If you want to sell but they don't want to buy it back, it is not your choice. It is the choice of the issuing company. Non-redeemable preference shares, it doesn't work like that. That can only be bought back when the company closes down, as we said earlier, for a reason other than liquidation. So if there's some other reason, okay, the people just decide, okay, they're closing down this company, they don't want to do this anymore, competition is too stiff, whatever reason, not liquidation. All right, with liquidation it works differently. But if the company closes down for a reason other than liquidation or bankruptcy, that is the only time that the company can actually buy back your shares, when they physically close the business down. Right, then we also distinguish between convertible preference shares and non-convertible preference shares. Convertible preference shares are preference shares that can be converted into a predetermined number of ordinary shares, again on the date specified when the preference shares were issued. So on the date that you buy ordinary or your convertible preference shares, on that day that the transaction takes place, If you have convertible preference shares, they are going to specify, the company will specify a date, and they will tell you that on this date, your convertible preference shares will be converted into ordinary shares. All right, and it doesn't have to be one preference share equals one ordinary share. That is at the discretion of the company. They will tell you, well, however many shares, preference shares you bought, on this specific date, we are going to convert those shares that you have into 10 ordinary shares or 20 ordinary shares or 100 ordinary shares. That is at their discretion. Non-convertible preference shares simply means that your preference shares will remain preference shares until the end of time. They cannot be converted into ordinary shares at all. Right, and then once again, you must be able to identify the types of preference shares from given scenarios. All right, so in the same way as like the other shares, if you must be able to identify from a scenario, if they give you a scenario, you must be able to identify whether it is cumulative or non-cumulative or convertible or non-convertible, or whatever the case may be. Yeah, that is important. That's how they ask it. Right, then what we're going to look at is we're going to look at the difference between ordinary shares and preference shares. Most of this information we have shared during this lesson. All right, so but we're just going to put this together now because they can actually physically ask you to distinguish between ordinary shares and preference shares. Then you're going to do it in this way. Right, we said that ordinary shareholders will only receive a dividend when the company makes a profit. If the company makes a loss, ordinary shareholders will not receive a dividend. Whereas in the case of your preference shares, certain preference shareholders will receive dividends regardless of how much profit is being made. So whether the company makes a profit or not, your preference shareholders will receive a dividend. With your ordinary shareholders, we said the higher the profit, normally the higher the dividend will be. Now, the dividend payout is linked to the amount of profit that a company makes. The more profit they make, the higher the dividend will be. In the case of preference shareholders, there is a fixed rate of return. So there is a fixed dividend, and the dividend that you receive does not depend on how much profit the business actually makes. Ordinary shareholders, we said they are the last to be paid in the case of liquidation. Now, we've explained that many times now. But in the case of preference shareholders, they have a preferred claim over your ordinary shareholders. Okay, remember I said creditors first, then preference shareholders, and then your ordinary shareholders. So they do have a preferred claim when the company is liquidated. Right, ordinary shares are what they say, ordinary, it is normal. They standard shares with no special rights or restrictions. All right, so they don't have special rights that preference shareholders doesn't have, and there's no restrictions placed on ordinary shareholders either. In the case of your preferential shareholders, obviously they have preferential rights to dividends, which means that before your ordinary shareholders are paid out their dividends, the preferential shareholders will receive their dividends first. All right, so in other words, if there's not enough profit, then your preferential shareholders will receive a dividend, whereas your ordinary shareholders might not. Right, your ordinary shareholders, your dividends vary from year to year, obviously because it depends on how profitable the company is. We said the more profit they make, the higher the dividend is that's going to be paid out, probably. All right, whereas with your preferential shareholders, dividends are payable according to the type of preferential shareholders that you have. Remember, your non-cumulative shareholders cannot receive outstanding dividends that was not paid out in previous years, whereas your cumulative shareholders will receive outstanding dividends that was not paid out in previous years. And remember, in most cases with your preference shareholders, we said that they have a fixed dividend. Okay, so it's not necessarily going to change. Every single year they will receive the same. Right, in terms of your ordinary shareholders, remember they have a right to attend the AGM and they have the right to vote at the AGM, one share, one vote. Whereas your preferential shareholders, they don't automatically have voting rights at the AGM. They will have voting rights only restricted to particular situations. Now, when certain situations arise, your preferential shareholders will also have a vote.